The Intelligent Investor. Summary. In The Intelligent Investor, Benjamin Graham lays out timeless principles for smart investing. This summary highlights key strategies and advice from the book, focusing on asset allocation, diversification, and maintaining a margin of safety. Asset allocation. Graham recommends a balanced portfolio of 50% stocks and 50% bonds. Adjust this allocation based on your life situation and the yield difference between stocks and bonds. Rebalance once or twice a year to maintain this ratio. For example, if stocks rise to 60% of your portfolio, sell some stocks and buy bonds until you return to a 50-50 split. This strategy, called dollar cost averaging, ensures you invest a fixed amount at regular intervals, helping you avoid buying at the wrong time. Defensive investor strategy. For the defensive investor, Graham advises diversification and specific criteria for stock selection. Diversification. Invest in 10 to 30 companies to reduce risk. Large companies. Choose companies with over $700 million in annual sales. Conservative financing. Look for a current ratio of at least 200%. Dividend record. The company should have paid dividends for at least 20 years. Earnings stability. No earnings deficit in the last 10 years. Moderate earnings. Growth. At least 33% growth over the last 10 years. Reasonable price. The stock price should not exceed 1.5 times its net asset value. Moderate PE ratio. The price-to-earnings ratio should be 15 or less. Alternatively, investing in an index fund can yield average market returns with less effort. Enterprising investor strategy. To beat the market, the enterprising investor must be patient, disciplined, and eager to learn. This approach is more demanding and requires avoiding the temptation to follow market trends blindly. Key principles include in-depth analysis, study annual financial reports, and Graham's book, The Interpretation of Financial Statements. Margin of safety. Ensure that every investment has a margin of safety by buying stocks priced at no more than 2/3 of their intrinsic value. Avoid growth stocks. Focus on undervalued companies rather than those with high growth expectations, as future earnings are less reliable. Valuation. Calculate a company's value using the formula value. Current earnings X, 8.5 plus 2, X expected annual growth rate. Margin of safety. The margin of safety principle minimizes the risk of being wrong. Always invest in stocks priced significantly below their calculated value to protect against errors in your analysis. This concept is akin to not building a ship that sinks with one extra passenger. Risk and reward. Graham challenges the academic theory that higher risk equals higher reward. He argues that the return on investment depends on the effort and intelligence applied to finding bargain assets. A defensive investor may achieve minimum returns, while an enterprising investor with skill and diligence can maximize returns. Conclusion. The Intelligent Investor offers invaluable advice for both defensive and enterprising investors. By adhering to principles like diversification, maintaining a margin of safety, and focusing on intrinsic value, you can navigate the complexities of investing and achieve financial success. What do you think of Graham's advice? Are they still applicable today? Share your thoughts in the comments. If you want me to summarize more books on investing, personal finance, or money management, let me know. And if any takeaway from this book stands out to you, feel free to ask for more details. Thanks for watching.